Hey, welcome back, IB International Economics students, to this video lecture. Today, we're going to go over an evaluation of the terms of trade. So, previously, we have gone over the definition of the terms of trade, some calculations of the terms of trade, and a formula of a term of trade. However, we have gone over some terminology of the deterioration and improvements in the terms of trade. Now, it is important that we go over the definition of it as well as what it means to have an improvement and deterioration of the terms of trade. So taken from face value, improvement in the terms of trade is when the value of the term of trade increases. So for example, from Y3 to Y4, we have an improvement in the terms of trade from 93 to 102. And from Y1 to Y2 and from Y2 to Y3, we have a deterioration of the terms of trade. Now, an improvement in the terms of trade is not always good, and a deterioration of the terms of trade is not always bad. What do I mean by that? If PED is inelastic, improvements in the TOT, improvements in the terms of trade, will lead to a current account surplus. However, if PED is elastic, improvements in TOT will lead to a current account deficit. Now, why is that? The current account is directly related to the exports and imports of a country's balance sheet. The TOT concerns the quantity of trade, whether imported or exported. Now, elasticity, once again, if you have reviewed the Marshall-Lerner condition or if you have reviewed the J-curve, we'll talk about how the current account balance is related to the trade quantity and the elasticity of the trade quantity. So once again, this is just illustrating how the relationship between the improvements of the terms of trade may not necessarily be beneficial for the current account or beneficial for the country in the short and long run. Now, once again, a deterioration sounds very bad, but it might not always be bad. A deterioration in the terms of trade, if price elasticity is elastic, then it will lead to a current account surplus. If price elasticity is inelastic, then it will lead to a deficit. So this is important to take note, how the terms of trade may not directly, how the terms of trade may not directly correlate into a surplus or a deficit for the current account. So this is the definitions for improvements and deterioration. So seeing this, looking at year 1 to 4, we can see from year 1 to year 2 have a deterioration. But depending on the price elasticity demand of the net exports, it may either be good for the country's current account balance, or it could be bad for the country's current account balance. There's the information is not sufficient in answering questions such as that. Now, so that's improvements and deterioration, some terminology definition. So what are the terms of trade? And we have to define the terms of trade, but what causes changes in the terms of trade? Now, first of all, we have changes in demand for exports. See, terms of trade, once again, calculates by using index for export prices. So changes in demand for exports, for example, when demand increases for a country's exports, price rises, Once again, the law of supply. And as price rises, the terms of trade improves and the aggregate demand increases. So terms of trade improves as more and more exports are demanded. As more exports are demanded, the price for exports increases, and the terms of trade improves, and the aggregate demand increases once again because of the improvement in the demand. Another reason for changes in the terms of trade is changes in the supply of exports. When the supply of a country's output increases, now how could in a neoclassical and a Keynesian view, in the long run, at least in the neoclassical, in the long run, a country is always producing at its production possibility or frontier. It's always producing at the maximum efficiency at full employment. However, in the short run, a country can push the production possibilities and increase the country's total output in the short run. Now, this will lead to a deterioration in the TOT, deterioration in the terms of trade. Now, so it's important to take note, a deterioration is not always bad, So in this case, a deterioration in the short run may be good, depending on the price elasticity of demand. If the price elasticity of demand is elastic, then having a deterioration in the TOT for the short run will actually be good for the current account, leading to a surplus Now, vice versa, if there's cost plus inflation, aka if there are negative supply shocks leading to an improvement of the TOT, then that's actually bad, okay? Because improvements in the TOT caused by inelastic deterioration will lead to a current account deficit. So that's actually bad for the economy's current account and bad for the economy's terms of trade, even though it has the ironic name of having an improvement in the terms of trade. Very well. Once again, another cause for the fluctuations in the terms of trade is the external factors. Think of countries like Saudi Arabia, who is highly reliant on fossil fuels, on oil and natural gases. External factors such as changes in commodity prices and changes in commodity demand will greatly increase or decrease, or so greatly fluctuate the commodity market for these export-oriented countries for commodities. So this will be another leading factor for improvements and deteriorations of the terms of trade for these countries. Fourthly, changes in exchange rate is another major one. Stronger exchange rates will improve the terms of trade, while weaker exchange rates will deteriorate the terms of trade. Now, it's important to take note that improvements and deteriorations is not necessarily good or not necessarily bad for the economy. It is all up to, once again, we have talked about the Marshall-Lerner condition, we have talked about the J-curve condition. It is all up to the price elasticity of demand in order to determine whether or not it is positive or whether or not it is negative for the current account surplus and deficit for the given economy. So here is the evaluation of the terms of trade, given conditions for rises and decreases of the terms of trade, as well as improvements and deteriorations of set trade, given the price elasticity of demand, as well as previously we have talked about calculations.